Greetings, investor enthusiasts. Welcome to HouseLux Estate, your go-to place for all things investment. Here at HouseLux, our mission is to arm you with insights and strategies, breaking down complex investment concepts into digestible, actionable content. Whether you're a seasoned investor or just starting your journey, we've got a wealth of knowledge to share. From real estate to stocks, bonds, and beyond, we cover a diverse range of investment opportunities. Today, we delve into the risks and rewards of dividend investing in 2025. Before we venture into the future, let's ensure we understand what dividend investing is. Simply put, dividend investing is a strategy where investors purchase stocks, mutual funds, or other investments that pay out dividends. Now, you might ask, what exactly are dividends? Well, dividends are a portion of a company's profit that it decides to distribute back to its shareholders. This distribution is usually done on a regular basis, such as quarterly, semi-annually, or annually. These dividends can be seen as a reward for investing in the company and can be either reinvested or taken as cash. But why do investors opt for dividend investing? There are several reasons. Firstly, it provides a steady stream of income, which can be particularly attractive for those seeking to generate passive income or for retirees. Secondly, dividends are often seen as a sign of a company's financial health. Companies that regularly pay dividends are typically stable and profitable. Lastly, dividend investing can offer a buffer in volatile markets. Even if the stock price falls, investors can still receive dividends. However, like all investment strategies, dividend investing is not without its complexities and requires a keen understanding of the market dynamics and the company's financial health. But don't worry, we'll delve into that in the upcoming segments. Now that we have a grasp of dividend investing, let's venture into its risks and rewards in 2025. No investment comes without risks. Dividend investing in 2025 is no exception. As we peer into the crystal ball of 2025, we can discern several potential risks that loom on the horizon for dividend investors. First and foremost is market volatility. As we all know, the stock market is a roller coaster ride, and it's not for the faint of heart. When the market is on an upswing, dividend stocks can be a great way to generate income. But when the market takes a downturn, dividend stocks can be hit hard. In 2025, we can expect more of the unexpected. Global events, economic shifts, and technological advancements can all contribute to market volatility. For dividend investors, this means that the steady income they're counting on today could become less predictable tomorrow. Secondly, changes in tax laws can also pose a risk to dividend investors. In many countries, dividend income is taxed at a lower rate than other forms of income. But these laws are subject to change. As governments grapple with the economic fallout of the pandemic, they may look to increase taxes on dividend income. For dividend investors, this could mean a significant reduction in their take-home pay. Another risk for dividend investors in 2025 is the financial instability of the companies they're invested in. Companies can only pay dividends if they're making a profit. If a company's financial health deteriorates, it may be forced to cut or eliminate its dividend. This can lead to a significant loss for investors who were counting on that income. Moreover, the global shift towards sustainability and ESG investing could impact certain sectors more heavily, potentially affecting their ability to maintain steady dividends. This underscores the importance of diversifying your portfolio and not putting all your eggs in one basket. Lastly, the threat of inflation cannot be overlooked. In an inflationary environment, the purchasing power of dividend income can be eroded. This means that even if a company continues to pay the same amount in dividends, those dividends may not go as far as they once did. Despite these risks, many investors still find dividend investing an appealing strategy. Let's explore why. Investors are drawn to dividend investing for a reason. The rewards can be quite enticing. When we talk about the rewards of dividend investing, we're looking at a multifaceted treasure chest of benefits. The first and most direct reward is the generation of a steady income stream. Companies that have a history of consistently paying dividends are often well established with stable earnings. These regular dividend payments can act as a reliable source of income, especially appealing in a year like 2025, where economic stability is a sought-after luxury. Now, imagine you're on a ship sailing towards your financial goals. Capital appreciation is the wind in your sails, accelerating your journey. When a company's stock price increases over time, investors benefit from the rise in value. This is capital appreciation. It's like a cherry on top of your dividend sundae, providing an additional avenue for potential profit. But let's not forget about one of the most powerful tools in an investor's arsenal: reinvestment. When you reinvest your dividends, you're buying more shares of the company. This can lead to what's known as compounding, a snowball effect where your earnings generate even more earnings. It's a tried and true way to grow your wealth over the long term. Related to this, dividend investing also offers a degree of flexibility. You can choose to spend your dividends, reinvest them, or do a bit of both. This flexibility can be particularly valuable in uncertain times, giving you options to adapt to changing financial circumstances. Now, dividends also provide a bit of a cushion against market volatility. Companies that regularly pay dividends tend to be more stable and less likely to experience drastic price fluctuations. This makes them a solid choice for risk-averse investors seeking to preserve their capital. The potential rewards of dividend investing can also extend beyond the financial. There's a certain psychological comfort in owning shares in a company that regularly returns a portion of its profits to its shareholders. It's a tangible reminder that your investment is working for you, even in times of market uncertainty. In 2025, these rewards make dividend investing an appealing strategy for many. But it's important to remember that these rewards don't come without risks. There's no such thing as a sure bet in investing. Companies can and do cut their dividends, and stock prices can fall. That's why it's essential to do your homework. Understand the company you're investing in, its dividend history, and its future prospects. Diversify your portfolio to spread risk. And always have a clear investment strategy in place. Knowing the risks and rewards can help you make informed decisions. But remember, every investment strategy requires careful planning. Investing in dividends can be a rewarding strategy, but it's not without its risks. We've delved deep into the world of dividend investing, and as we've seen, it's a landscape of both immense opportunities and considerable challenges. Let's rewind a little and revisit some of the key points we've discussed. Dividend investing, at its core, is about acquiring shares in a company that regularly pays out a portion of its profits to its shareholders. It's a strategy that can provide a steady stream of income, making it particularly attractive for those looking for financial stability. Fast forwarding to 2025, the rewards of dividend investing can be substantial. A well-chosen portfolio of dividend-paying stocks can offer a consistent income stream, potential for capital appreciation, and a hedge against inflation. Moreover, with companies that have a history of increasing their dividends, investors may experience a growth in income that can outpace inflation, providing a real increase in purchasing power. However, as we've emphasized, there's no such thing as a free lunch in investing. Alongside these rewards come risks. In 2025, these risks may be further magnified by factors such as economic instability, changes in tax laws, and company-specific issues. A company's dividend can be cut or eliminated at any time, which can lead to a significant loss in income for the investor. Furthermore, focusing too heavily on dividends can lead to a lack of diversification, which can increase the risk of your portfolio. The key to navigating these risks, as we've discussed, is diligent research and diversification. It's crucial to understand the company you're investing in, its dividend history, and its future prospects. Diversifying your investments across different sectors and companies can also help mitigate the risks associated with dividend investing. In conclusion, dividend investing in 2025 presents a unique blend of potential rewards and inherent risks. It's a strategy that requires careful consideration and proactive management. But for those willing to do their homework and approach it with a well-rounded strategy, the rewards can be well worth the effort. That wraps up our discussion on dividend investing in 2025. Don't forget to subscribe to House Lux Estate for more investment insights. Until next time, invest wisely.